As some of you might recognize, I am in Sunny Isles Beach today in a little park over here right across the street from the beach. I didn't catch the name, but of course I'll put it up on the map like I always do. And we'll walk around this park a little bit, maybe around the neighborhood a little bit too if we have time. And the first thing I wanted to talk about today, which I thought was really interesting, is this. There was a poll of over 100 economists about what's going to happen with the housing market in 2023. And it was determined through this poll that 56% of the economists who took this survey say that it's going to be a buyer's market at some point in 2023. Sounds familiar, right? Well, anybody who watched my video about the housing market predictions for 2023, that was one of the things I said. And last night, when I was watching YouTube, I also saw a video from CBS News talking about the same thing as well. So I guess all these guys saw my video and are now starting to agree with my predictions on this. So it's pretty interesting that a lot of these economists that they surveyed, these were all the same guys that were saying, a year ago, even the beginning of this year, oh, this can never happen. The housing market's way too strong. Demand is still through the roof. Interest rates are low. Well, look at this now, guys. All these people that said everything was beautiful are starting to change their tune and are actually predicting a buyer's market in 2023. And real quick, once again, what was the definition of the buyer's market? The definition is that we have...
Excuse me, what?
We can't come back here?
No.
Oh, okay.
We're looking for something, but...
Oh, all right. I didn't know.
This was an old skate park.
Oh, yeah?
Yeah, well, not anymore. It's grass, but it used to be.
Looks like they're going to put the awnings up here, huh?
No, it had the awnings. This was the way it was always with the old skate park, and then they had, obviously where the grass is was the concrete.
Oh, okay.
I don't think they thought about what they're gonna do here.
What are you guys looking for?
An iPhone, stolen iPhone was pinging back here, so that's what we were looking for.
Oh, probably in the bushes, right?
Possibly.
Yeah.
Possibly.
Well, good luck.
Thank you. Take care.
All right, you too. Always something interesting in Miami, guys, that's for sure. So we'll go the other way. What is a buyer's market? A buyer's market simply just means that there is 6 months or more of inventory on the market and that buying conditions have become favorable for buyers once again, which gives them leverage when negotiating purchase contracts with sellers. That's all it means. It doesn't mean that prices are going to hit record lows or that they're going to go back to 2019 levels or anything like that. That could happen. It's a possibility, but that's not what a buyer's market is. Just to be clear, 24% of these economists surveyed said that they're seeing the buyer's market not coming until 2024. So probably a quarter of these economists sound like they're still pretty bullish on the housing market, thinking that things are still going to be pretty strong next year. And honestly, guys, I don't know how anyone can see that. Just like at the beginning of this year, I don't know how any of these guys said that things were still going to stay strong through the end of this year. Well, everything's already starting to crater. For them to say that the buyer's market isn't going to come till 2024 is kind of ridiculous. We know that's not true because the buyer's market is already well on its way here. We only need like 3 months more of inventory added to the housing market and we're in a buyer's market, guys. So it's coming. Probably first half of 2023, most likely. See, it's pretty cool. All over this park, they have these different little workout stations here. They have a lot of this in Miami Beach too. So it's just neat to come somewhere different. Across the street, we got multi-million-dollar condos right on the beach. Bunch of brand new ones. I always make fun of this place. They call this Sunny Isles Beach, but I call it Dark Isles Beach because if you want to actually go to the beach after like 1:30, 2 o'clock, there's no sun. All these giant towers block the sun, guys. So it's kind of ironic they call it Sunny Isles because it's only sunny on this side of these buildings. Now, one fascinating thing I read in this article with the poll for The Economist is they're saying that inexpensive Midwest markets like Columbus, Ohio, Indianapolis, Indiana, and Minneapolis are the least likely to see price declines over the next 12 months. And I would actually agree with that, guys. And why is that? Because these Midwest markets are not extremely expensive. It's not like Miami or California or New York or these crazy places where real estate prices are detached from reality. in these smaller housing markets, you know, the local home prices are still in line with what local wage earners can afford to pay. And that's why these kind of markets that are much more stable like this are not going to see these massive crashes. They're going to weather this housing crash much better than say somewhere like Miami here, or Las Vegas, or San Francisco, or places where prices are just completely detached from reality, essentially. You can just look anywhere where we saw the most increase in prices. Those are most likely the places that are going to see the biggest decrease in prices as well. Big surprise, right? Now, speaking of a buyer's market, a few days ago, I put up another poll on the channel, and I asked you guys this question, which is, if you're a current homeowner and you had the opportunity to sell right now, but you had to sell at 2019 prices, but then you could turn around and buy a home at today's interest rates at 2019 prices, would you do it? And I think looking back, the way I worded that question was probably a little too confusing, but the results of the poll were that 18% of you said yes, 68% of you said no, and 15% of you said I'm never selling. So the overwhelming majority of people said that, you know, they would not be up for a situation like this. But here's the interesting thing, guys. We're already going to be looking at a buyer's market in 2023, most likely. Current sellers and current homeowners, that most of them say that they would not want to buy at today's interest rates even if they could get in at 2019 prices, because they would have to sell at 2019 prices as well. I think a lot of people are being unrealistic. Now, of course, the ones that say they're never going to sell, they probably won't, and they'll probably turn the home into a rental, and that's what I would do too. But a lot of people cannot afford to do that. Most people that need to move always need to sell their current home in order to buy the next one. So that's what majority of people end up usually doing. So one guy said, I'm a homeowner. If I bought again at today's interest rates, home prices would have to drop a considerable percentage. Now, of course, I agree, guys, but that just means you would also have to sell at a lower price as well. There's no way for you to buy at a lower price without selling at a lower price too. And I think that's probably one piece of it that people didn't really understand and what I was asking, because this goes back to the lock-in effect. People that have really low rates and are stuck in their house because they have such a good deal on the mortgage and can't move, because if they do, they're going to be paying today's interest rates, which are double. But like I said, if you could get in at today's rate but 2019 prices, would you do it? Most people said they wouldn't. But guys, that's what we're looking at for the future of the housing market here. So you're going to be stuck forever if you're not willing to jump into that situation, is what I'm thinking. Because the only way to avoid this is you would have to sell right now, or you sold earlier in 2022 for top dollar, and then you're going to be just sitting on the cash and renting somewhere in the meantime and waiting to buy for the 2019 prices. And that's how, the only way you could circumvent buying at a low price and selling at a high price. Otherwise, if you wait because you want a better deal on the next home you move to, well, you're also going to have to give a better deal in return to the buyer looking to buy your house. It works both ways. So I think maybe a lot of people misinterpreted this question. Like this one guy said here, Joe, he says, I'm trying to sell my house now and pay cash in another state. No more mortgage payments, but it's hard to get a buyer now with the rates so high. Lowered the price 3 times already, just way too many houses for sale right now. So this is what home sellers are up against in real time. Joe didn't say where he's located, but this is going to become the norm for anyone looking to sell right now. I mean, most people pretty much miss the boat unless you are in one of these markets that's still hopping and booming, which is going to come to an end soon. Now, another sign that we saw that the recession is here, we saw another inverted yield curve happen in the treasuries market. And on Wednesday morning, the yield on the 3-month treasury had surpassed the 10-year treasury. And they say that such an inversion is very rare, but it suggests that a recession is either on the way or is already here. And we all know, everyone who watches the channel, we all know that we're already in the recession. And this is just the latest data point that we have to look at that proves it, guys. I mean, this is indisputable at this point. And it's just laughable to me that we have CEOs and politicians still basically denying the fact that this is a recession. They just don't want to look at it and admit that this is really happening, essentially. And so the yields are right now for the 3-month Treasury bill, it's at 4.04%, and the 10-year is only at 4.01%. So it's not a huge difference, but like they said, this type of inversion is extremely rare, and every time this has happened before, it means the recession is here, guys. And just to put it simply, for anyone who doesn't know, what this means is it means when the yield curve inverts, it means that investors are moving money away from short-term bonds and into long-term ones. That's what's happening with this. And so this suggests that the market as a whole is becoming more pessimistic about the economic prospects of the near future. So then what they have to do, the Treasury Department has to offer a higher interest rate in the near term because people are scared of what's about to happen, essentially. Investors are worried of where things are going over the next few months. So they have to up the rate to incentivize people to invest the money right now into these short-term bonds. So that should tell you something right there. Now, speaking of recession warning signs, there was an article where Goldman Sachs says that the stock market has not bottomed out yet, and the pricing for further rate hikes has not been priced in, guys. You know, that's one thing a lot of people have been saying since the Fed has been doing these rate hikes is, oh, you know, don't worry, these rate hikes are already priced into the market. Well, clearly, if that were true, we wouldn't see most of the index funds down by 25 to 30% since the beginning of this year, first of all. Equities and credit would probably be especially vulnerable as they do more rate hikes. Oh, big surprise. And we know they're going to do more rate hikes. We're pretty much guaranteed to see one more this year, if not two more, and one more next year before they even think about doing a pivot. So if you think the stock market is down and it's bad right now, it's going to get worse. I just discovered this little pathway here. I didn't even know that this was here in Sunny Isles. And this is one of the cool things about getting out and doing these walking videos with you guys. Not only do you guys get to experience these different things, but this is something that I didn't even know was here, and I've lived here for almost 15 years now. So even for myself, this has been so fun and interesting just getting out here and seeing the different sites and discovering these little nooks and crannies of right in my own backyard I didn't even know about. So this has been super cool, guys. Hope you're enjoying this. So back to the stock market, they're saying that no asset class right now is pricing in a severe contraction. All the priced in downturns were for a mild correction, essentially. So these guys who are doing these price ins have been very bullish on the economy and are going to be in for a rude awakening when things don't turn out their way, essentially. And unfortunately, anyone who's invested in the markets, especially retirees, I feel the worst for people looking to retire in the next couple of years. They're going to get hammered the most. Sure, somebody that's in their 20s or 30s that has money in the market, they don't need it today. They'll be fine probably in the long run. At least we all hope they will be. But, you know, this is really bad news for people who are looking to start withdrawing that money in the next couple of years. Now, according to the most recent Case-Shiller Home Price Index, they are now predicting a forceful deceleration in home prices coming up. And one thing that a lot of people don't realize is that the housing market and the data that we have is all based on lagging indicators, because a lot of people point to the first thing in here like, oh, you know, home prices are up 13% year over year, which is true, guys. They are up 13% higher than last year. That is a fact. But when you look at the month over month of what's happening right now, the US National Index of prices for homes sold is down by 1.1% month over month, okay? And when you look at the 10 city and 20 city composites that they have, the decreases are down by 1.6%. And that's just in 1 month, guys. You know, people that want to deny this type of data and not look at it and recognize that this is happening, you know, you're just doing yourself a disservice, and honestly your family too, if you're trying to protect your family's future and your family's wealth. Because I get it, guys, you know, I at heart I'm an optimist, and I know a lot of this can sound like doom and gloom, but I always hope that everything is going to turn around and everything will be great for everyone. But that just doesn't seem to be the world that we live in anymore. You know, the elites are in charge of everything, and if you want to have a good life as a little guy, then the only advantage that you have is to be on top of the data and the information that we have access to, and try to make the best bets for your own future. That's all anyone can do right now, and that's what we're trying to do here on this channel. Now, one interesting thing about this Case-Shiller home price index report is that they're saying that the difference between August and July from this year is down by 2.6%. And apparently this is the single largest difference that they've ever recorded since they started the Case-Shiller home price index. So like I said in my housing crash video recently, we have never really seen the housing market crash this fast. And I know for people who are impatient buyers that are just desperate to buy right now, it might not look like it's happening that fast, but all we need to do is look at history and previous crashes to determine that it is crashing very fast, faster than ever, essentially. And I don't know what's going to happen here in Miami, because they say that in this index, Miami is now the leader, okay? We are up 28.6% year over year. That's just from this year to from last year, guys. And Tampa is up 28%. So these are the two highest cities in the nation, Tampa and Miami, that are up more than anywhere else. Does this mean that places like this are going to see a major crash? Potentially. You know, I've had a lot of people ask me about this in the comments, you know, where I think prices are going to go here, and obviously this is my market. Well, during the last crash, home prices in Miami dropped 50%, guys. My personal opinion, I think that prices will remain stronger this time around, mainly just from the perspective that there is so much money flowing into Miami from all over the world and from all over the country that I think it will be enough to keep home prices propped up. But I don't think that doesn't mean we can't have a crash here as well, because since we have seen the largest run up in the nation when it comes to prices, we could also see the biggest crash in the nation as well. But is it going to be 50% this time? I don't think so. I think we could at least see 20 to 30% crash here in Miami, but maybe not more than that, unless all the foreign investment dries up and people just stop moving here, essentially. If that happens, then sure, I think we can see another 50% decline. You know, Tampa is going to maybe experience their worst housing crash ever during this, because they were neck and neck with Miami when it comes to their growth. Since that was also another big pandemic destination, then we could see at least 20 to 30% drops over there as well, I believe. So all this gained equity that we've seen over the past year, you know, these 28% increases, I think we could see that go away over the next couple years if this recession gets really bad. So that's my take on it as a local, predicting somewhere between 20 to 30% declines in Miami and Tampa. I could be wrong. It's just a guess, really. If you guys enjoyed this video, make sure you hit the bell notification down below. YouTube will alert you right away of all my brand new uploads. And if you don't want to wait for that, then check out my next one on the screen right over here, and I'll see you in the next one.